The dollar is strengthening. The US dollar rose about 1.1% against a basket of currencies to hit more than a one-month high. It was still down 2.3% from Trump's April 2nd announcement of sweeping tariffs, as the chaotic rollout of policies shook confidence in US assets, particularly treasuries and the US dollar. According to Reuters, back home, the rupee was holding strong. I reached out to Abhishek Goenka, founder and CEO of India Forex and Asset Management, or IFA Global, and founder and CEO of Billions, and began by asking him how the rupee was likely to move given the dollar's strength and shifts in currencies once again post the China-US deal.
After the Donald Trump had come to power, we saw a huge US dollar strength because the narrative was different. And now, once people have started having discomfort with America because of its policies, whether it's trade or anything else, defense, etc., somehow we are seeing that people are shunning the US dollar because somehow people feel that, the US growth is going to come down. They're going to have recession and the probability have increased. They're going to cut rates further. And that's the reason the US dollar bear run have started. Now, because of which, what's happening, the other Asian currencies, like you saw the news of Taiwan, which you mentioned, there is one thought that a lot of countries were keeping their currencies artificially weak. Some of the countries were also called as manipulators in currencies. So I think the message is very strong that you cannot keep your currency artificially weak. So I think some of the currencies which are getting very strong, despite the original nature of the currency which was weak, I think I could see that shift happening. There are no confirmed reports on that, but that's the feeling I get. At the same time, in case of India, Govind, I think few of the things are working really well for India. One is, of course, as we all know, that for India, the most important factor is the oil. And oil has been holding at $60, and which is adding a lot of money to our overall balance of payment. Now, once RBI is inactive in the market and oil is at $60, if you can remember COVID when the oil went to $20-$25, from 77 to a dollar, a rupee came to 72, despite all the hue and cry in the market, because oil was at 20. So for us, if oil is at 60 and it stays like that, the message is very clear that we hit a very solid BOP positive. And also, for us, the foreign institutional holding in equity markets is all-time low. And today also we saw the markets moving 4% after tensions de-escalated between India and Pakistan, and now the new story of US and China. So I think risk on is back. Chinese currency have appreciated at 7.22 a US dollar. And I think in the NDF markets, we can see rupee also pretty strong. It's below 84. A couple of days back, it was 85.80. So I think the dollar bearer is likely to stay and currencies are going to get slightly strong. But I would like to insist on one thing, that dollar rupee is broadly a depreciating currency. So a 2% on this currency is warranted year on year. So if a couple of years back we started at 83 and comfortably add 4% to it, then I think this year we should average close to 86.5, 87. I still maintain that.
Got it. So you're saying that this trajectory would have continued whether or not US and China have a new trade deal, fears of recession, at least that extent of recession go away, things return to some sort of normalcy on the trade front. You're saying that these trajectories will remain as they are. And when I say these, I mean the US dollar to INR.
After spending 20 years in market, one thing I've learned that the interest rate differentials and inflation differentials prevail. And for India, that is still prevailing. So I think we can see a flat rupee for a year, but on a span of 5 years, if you see, on a compounding depreciation of 2.2% is warranted. And that's the broad policy for us as a government. Now, these short-term weaknesses in the US dollar can derail this depreciation for a few months, but broadly that's going to hold. So I think I don't see a very, very strong rupee. I feel that rupee should not go below 83 half, but I think over that levels, the importer is going to be very, very active. They're going to cover for 3, 4, 5 months. but I don't see a very strong holding for a very long time. It has never happened in the past. It is most likely never going to happen till the time we have this current account deficit, and also we have this broad inflation story, which is relatively higher than America.
What are the other trends that you're seeing, Abhishek, as you look ahead? I mean, one is, of course, the straight sort of USD to INR rate. I mean, I take your point on the steady depreciation that we've been seeing for some time. Are there any other trends, or do you see any other factors that could affect either our forex reserves or the volatility in the market?
So we have here spent a lot of foreign exchange reserves, as we know. I mean, we have used a lot in the last intervention when the rupee was going all the way to 88. And I think the vision is very clear that in terms of foreign exchange reserves, we want to hit $1 trillion. And that's another reason if we start seeing a gush of inflow in Indian markets, even though the valuations are little, it's fairly priced, and small and mid cap, as we all know, it's very, very highly priced. But the FII money have started coming in. Today moves, in few days move, you can see the large caps, the few selected FII favorites have been going up. So if we see a liquidity rally because we see a sell-off in America because of higher valuations in America and also the tech fall that we recently saw, I'm a believer that America is very, very fairly priced. It should fall down at least 15-20%. Then that part of that money can come to emerging markets, including India. And already you can see that money coming in. If you see the total Vanguard World Index is 10% plus, whereas if you see America, I think till yesterday it was minus for this year. And the rest of the emerging markets and Asia is also moving up. So I think if that happens, then two things can happen. Now, if oil stays at 60, we start saving at least 30, 35, $40 billion extra. So every $10, it gives us 15 billion. So I think $20, it gives us 30 billion. Plus, since FII holding is very, very low in Indian markets, there's not much room to sell. So in that case, if that money comes in, then we get a double benefit. So if we get the benefit from a capital account side and from the current account side, both together, then I think that 83 base can be broken for some time, because then we see a gush of liquidity, billions of dollars flowing in, oil staying at 60, then it's a different game. Then we're looking at building up huge, huge foreign exchange reserves, and also RBI will let rupee appreciate a little bit more. So that's a scenario which is a 10-15% probability. If that happens, obviously this gets broken. Otherwise, I think if both doesn't happen in the same fashion, then it's the same story.
Abhishek, thank you so much for joining me.